Listen up, because what I'm about to share with you in the next several minutes could fundamentally change how you view the current financial system. On February 6th, between 2:15 and 4 p.m. Eastern Standard Time, something shifted in the Treasury market that we haven't witnessed since September of 2019. The yield curve inverted by 85 basis points in a matter of hours. By trading close in New York, the 10-year to 2-year spread had compressed to negative 22 basis points on the futures curve. Now, if these figures don't immediately trigger concern, let me make something absolutely transparent about what this represents and what it doesn't. This isn't a meltdown. This isn't emotional trading fueled by news cycles. This isn't conjecture or academic debate. What you're observing is the fundamental reassessment of duration risk throughout the entire sovereign debt ecosystem, and it's unfolding at an accelerated pace. Institutions are trapped. The Treasury mechanism that finances government operations, that supports pension fund allocations every quarter, that maintains the solvency of leveraged institutions, is grinding to a halt. And when sovereign debt markets malfunction, everything connected to them fractures. Not in 12 months, not following a Federal Reserve statement. Right now. Over the following 30 minutes, I'm going to guide you through the structural deterioration of what's occurring in the government bond markets, why this yield curve signal is the ultimate alert before a cascade of institutional failures that will exceed anything we experienced in 2001, and most importantly, the 3 strategic positions you must comprehend immediately if you want to safeguard your capital and profit from the displacement that's already underway. By the conclusion of this presentation, you will possess a more comprehensive understanding of macro risk than 98% of individual investors, and you will know precisely how to respond to it. So remain with me through the entire video, because this is not theoretical. I have observed this sequence previously. The names of the players shift, the vehicles shift, the underlying dynamics remain constant. When yield curves invert this dramatically, it's because someone somewhere in the ecosystem stopped being able to finance their duration mismatch, and the market is now incorporating the probability that others will follow. This isn't about market psychology. This is about fundamental imbalances. Let me walk you through what has transpired chronologically, because in fixed income markets, the order of events matters more than commentary. January 31st, a mid-sized insurance company in Connecticut revealed that it had failed to meet a collateral call on a portfolio of Treasury futures. The announcement was concealed in regulatory filings. No mainstream media attention. But what's significant is this. The position was backed by long-duration government securities financing shorter-term obligations. Those obligations had been rolling on 60-day intervals. That interval collapsed February 2nd. 4 days later, another institutional fund in the same duration space froze investor exits, not due to realized losses, because it couldn't liquidate the underlying treasuries quickly enough to satisfy redemption demands. The bonds were still AAA-rated sovereign debt, but there were no counterparties willing to transact. February 4th, during overnight trading, the spread on 30-year Treasury bonds versus 5-year notes widened from 1.8 to 3.6. That represents a 180 basis point movement in under 10 hours. By morning session opening, 3 additional funds had restricted withdrawals. This isn't orchestrated. This is cascading. Each participant is responding to the identical structural challenge. They cannot liquidate holdings without creating adverse price movements against their own positions, and every liquidation attempt compounds the difficulty for the subsequent exit. Now observe the pattern. Connecticut insurer constrained, Singapore-based sovereign wealth vehicle constrained. A municipal pension treasury ladder ETF halted share creations. These aren't identical organizations. They aren't even operating under the same regulatory frameworks, but they're all confronting the identical limitation. Illiquid duration exposure in an infrastructure that presumed liquidity would perpetually exist. And here's what's critical. The interval between each incident is contracting. January 31st to February 2nd, 4 days. February 2nd to February 4th, 2 days. February 4th to February 6th, 1 day. This isn't expansion, this is acceleration. The system is exhausting its capacity to distribute stress without triggering forced actions. Let me clarify what this signifies beyond sovereign bond funds. Institutional investors in the duration arbitrage market depend on the capability to rebalance every 30 to 60 days. They don't maintain sufficient liquidity to close out positions. They roll them forward. If curve dynamics persist this inverted, rolling becomes economically destructive. Some institutions will elect to unwind rather than accept funding costs at 8% above their portfolio yields. That's a logical choice. But here's the derivative consequence. The counterparties holding those positions are regulated financial institutions. U.S. money center banks hold approximately $2.4 trillion in Treasury securities. Japanese banks hold another $1.1 trillion. If forced liquidations increase, those institutions face mark-to-market impacts on their sovereign portfolios. That influences their leverage ratios, that influences their lending capacity, that influences depositor sentiment, not instantly, but sequentially. And we're already witnessing the initial phase of that sequence materialize in live markets. 4 institutions have discreetly accessed the Federal Reserve's standing repo facility in the previous 96 hours. That information is published with a 3-week delay, so the public won't observe it until early March, but the institutions are aware and they're responding. Now here's where the chronology becomes essential. On February 13th, $124 billion in Treasury repo positions require refinancing. On February 18th, another $89 billion. These aren't discretionary dates, these are contractual obligations. If curve inversion remains beyond -20, a material percentage of those positions will be unable to refinance at economics they can sustain. They will either negotiate rollovers, which demands counterparty consent, or they will initiate unwinding discussions. Both pathways require time, and time is the single asset that's now depleted. Meanwhile, the funds that have restricted redemptions are confronting their own constraints. Most suspension mechanisms are limited at 45 days under governing documents. Beyond that threshold, they must either resume or commence liquidation. If they resume and withdrawal requests continue, they'll be compelled to sell into a non-liquid environment. If they liquidate, the selling momentum intensifies. There's no pathway where this resolves without additional price determination, and price determination in a non-liquid market means further curve distortion. So here's what we're monitoring closely. First, whether any of the restricted funds transition to complete liquidation before February 13th. If they do, that will establish a clearing price for duration exposure, and that clearing level may be more severe than the market presently anticipates. Second, whether the institutions that access the repo facility begin disclosing portfolio strain. They aren't obligated to disclose immediately, but if funding outflows intensify, they may be compelled to. Third, whether institutional players begin pre-disclosing rebalancing failures. That hasn't occurred yet, but if curve inversion persists beyond -25 for more than 7 trading sessions, it becomes probable. Fourth, whether regulatory bodies intervene with emergency funding mechanisms. The Federal Reserve has instruments. The question is whether they activate them before unwinding begins or afterward. What we don't yet understand is how much of this strain is isolated to duration arbitrage and how much propagates into equity volatility, commodity markets, or derivative structures. That will depend on whether institutions retreat comprehensively or exclusively in sovereign duration segments. We'll understand more by February 15th. To comprehend why this matters, you need to examine precedent. Because this framework, sovereign bond market stress leading to systemic fragmentation, has materialized 3 times in the past 90 years with catastrophic outcomes for those unprepared and generational wealth accumulation for those who identified it emerging. The first comparison is the panic of 1907, and specifically the liquidity crisis of 1907 to 1908. Most individuals believe the banking panic was the primary event, but that's a fundamental misinterpretation of what actually obliterated capital. The genuine destruction occurred in the months following the panic, when the money markets froze completely. Financial institutions ceased extending credit. Industrial financing evaporated. Funding spreads exploded as creditors understood that the speculation boom of the early 1900s was constructed on unstable foundations. Between 1907 and 1908, over 200 trust companies and banks collapsed in the United States. These weren't insignificant local operations. These were the cornerstones of American finance. And they disintegrated because the borrowers couldn't perform, the assets were overvalued, and the credit infrastructure seized. What's essential to recognize is that the investors who maintained and expanded their wealth during this interval were the individuals who identified the sovereign debt warning indicators early. They exited from overextended industrial equities and trust company obligations and repositioned into tangible reserves, particularly gold certificates, which maintained purchasing power while paper assets were decimated. They also acquired deeply undervalued productive assets, railroad bonds, mineral rights, and complete manufacturing operations at fractions of intrinsic value. The insight here isn't to forecast the precise moment of breakdown, but to identify the structural misalignment and allocate accordingly. Funding market dislocations in 1907 were the final signal before the comprehensive systemic fragmentation. Those who recognized that signal and restructured their holdings were the individuals who emerged substantially wealthier on the opposite side. The second historical comparison is the sovereign debt crisis of the early 1980s, and this one is even more applicable to our present circumstances. In the late 1970s, the United States was submerged in inflation from Vietnam-era spending and expansive social programs. The Federal Reserve under Paul Volcker was forced to raise interest rates to unprecedented levels to break the inflation spiral. What followed was economic devastation. Interest rates exceeded 20%, the economy contracted severely, unemployment soared, and sovereign debt yields, predictably, exploded upward. Governments and corporations faced financing costs that were economically unsustainable. The credit infrastructure didn't freeze completely like it did in 1907, but it became severely impaired. And here's the crucial understanding. During this interval, traditional diversified equity and bond allocations were annihilated. Equities collapsed in real terms throughout the early 1980s. Bonds experienced historic losses as yields climbed relentlessly, but tangible assets, precious metals, and certain commodity sectors exploded in value. Gold had already surged from $35 to over $850 by 1980. Energy infrastructure, resource extraction companies, and physical assets dramatically outperformed financial instruments. The investors who recognized that the sovereign debt market stress of the late 1970s was an indicator of deeper systemic inflation, and who repositioned into inflation-resistant tangible stores of wealth didn't merely survive the period. They achieved prosperity beyond conventional expectations. The lesson from the early 1980s is that when fixed income markets signal distress in an environment of monetary expansion and fiscal imbalance, the asymmetric opportunity is to transition away from duration exposure and into real, inflation-resistant value stores. And that connects us to our current moment. We have greater sovereign debt levels than the 1900s. We have more expansive monetary intervention than the 1980s. And now yield curves are inverting dramatically, just like they did before both of those historic displacements. If you comprehend these patterns, the trajectory forward becomes evident. Global sovereign indebtedness has reached absolutely extraordinary levels. According to the International Monetary Fund, global government debt exceeded $102 trillion in 2025, which represents over 95% of global economic output. This encompasses federal obligations, state and local debt, and quasi-sovereign commitments. To state it directly, governments have accumulated more liabilities than they can realistically service at current borrowing costs. For multiple decades, this wasn't problematic because financing rates were at or approaching zero. Governments could refinance their obligations inexpensively indefinitely. But now, with monetary authorities having elevated rates aggressively to combat inflation, the expense of servicing that debt has multiplied. Sovereigns that financed heavily during the zero-rate environment are now confronting refinancing at 4%, 5%, 6%, or higher. Many simply cannot sustain it economically, and creditors understand this reality. They're examining the maturity schedules, the enormous volumes of debt requiring refinancing in 2026 and 2027, and they're concluding that a significant portion of those obligations will be restructured or monetized. That's why yield curves are inverting. Markets are incorporating a future where monetary authorities are forced to suppress long-term rates regardless of inflation consequences. The second factor is the restoration of positive real yields. For over 15 years, real yields, meaning the nominal government bond yield minus the inflation rate, were deeply negative. You could hold sovereign debt yielding 1% when inflation was 4%, meaning you were guaranteed to lose purchasing power. This created an enormous incentive for financial engineering to leverage government debt and invest in anything offering yield pickup. But now real yields have turned materially positive. The Federal Reserve's policy rate substantially exceeds the inflation rate, and that fundamentally transforms the calculation. Positive real yields mean that sovereign debt is now economically expensive, not free capital. It must be financed from genuine economic productivity, and in an environment of decelerating growth, that's nearly impossible for over-leveraged governments. This is why we're observing stress in peripheral European debt, in emerging market sovereigns, in municipalities that expanded during the zero-rate era. The instant real yields turned positive, their fiscal models became unsustainable, and markets are recognizing this reality. They're withdrawing, demanding higher compensation, and in numerous cases refusing to provide additional financing. The third factor, and this is the element most observers completely overlook, is what I call the silent architecture of monetary subordination. Central banks globally are constrained. They have massive balance sheets, aging demographic obligations, and extensive policy commitments they cannot fulfill without either defaulting explicitly, inflating obligations away, or implementing financial subordination. Financial subordination is a policy structure where authorities deliberately suppress interest rates below the inflation rate, compelling savers and creditors to accept negative real returns while the government inflates away the real burden of its debt. We observed this following World War II, and we're observing it materializing again presently. But here's the complication. Financial subordination requires compliance from market participants. It requires creditors to continue financing at artificially suppressed rates. And when creditors begin resisting, when they begin demanding higher yields to compensate for the inflation transfer, the entire architecture fractures. That's what's occurring now. Markets are communicating. We're not going to accept negative real returns indefinitely. We're not going to continue financing governments that are fundamentally insolvent. We demand appropriate compensation or we're exiting. And that resistance is manifesting in the yield curve dynamics. So what are the three asymmetric opportunities in this environment? Let me be exceptionally clear about this. The first opportunity is selective value in dislocated sovereign and quasi-sovereign debt. When yield curves invert and volatility expands, it creates opportunities to acquire high-quality duration at distressed valuations. I'm referencing investment-grade municipal bonds trading at substantial discounts, senior sovereign obligations with strong institutional backing, and select corporate debt in cash-generative sectors that are being indiscriminately sold. The key is to focus on credit quality and volatility mismatch. You want exposure to fiscally sound issuers with genuine revenues that are being mispriced because of systemic panic. This is how sophisticated capital made extraordinary returns in 2002 and 2003. They acquired quality duration at Depression-era valuations and maintained positions through the normalization. The second opportunity is leveraged inflation exposure, specifically in tangible assets and resource producers. If the yield curve dislocation forces monetary authorities to reverse course toward accommodation, which is virtually certain given the debt burdens, we're going to experience another inflationary wave. The assets that benefit most from this environment are those with pricing power and intrinsic worth. Energy infrastructure, agricultural production, precious metals extraction, and essential commodity producers. These are the assets that appreciated dramatically in the 1970s and early 1980s, and they're positioning for a comparable movement presently. The third opportunity, and this is the systemic protection, is physical precious metals allocated outside the banking system. I cannot emphasize this sufficiently. When sovereign debt markets malfunction, when confidence in monetary authorities deteriorates, when the currency itself is being debased through inflation and financial subordination, there is no alternative to physical gold and silver. Not derivative exposure, not exchange-traded products, but physical metal that you possess directly. Gold isn't speculation, it's preservation. It's the ultimate form of wealth insurance that has endured every monetary crisis in recorded history. And silver, with its combined role as both monetary reserve and industrial input, offers even greater asymmetric potential. If you don't maintain a substantial allocation to physical precious metals currently, you're accepting uncompensated systemic risk in your portfolio. Now let me be specific about what you need to execute immediately. This is your implementation framework, and I want you to approach this seriously because the window for optimal positioning is narrowing rapidly. First, you need to evaluate your current portfolio structure and ask yourself honestly how much exposure you maintain to duration risk. If you own long-dated government bonds, municipal debt, or equity in interest rate-sensitive sectors, you need to understand that those positions are vulnerable in a yield curve dislocation environment. I'm not suggesting liquidate everything frantically, but you need to stress, test your holdings, and reduce exposure to anything that depends on stable curve dynamics to perform. Second, you need to establish a position in physical precious metals if you haven't already. I recommend a minimum allocation of 12 to 18% of your investable capital in physical gold and silver stored securely outside traditional banking institutions. This isn't a speculation. This is a long-term protection against systemic risk and currency devaluation. Third, you need to begin identifying selective value opportunities in dislocated sovereign debt and undervalued sectors. This demands research and discipline, but the asymmetric potential is substantial. Look for quality issuers trading at multi-year wide spreads, strong fiscal foundations with mispriced obligations, and sectors that are being irrationally punished by systematic selling. Fourth, consider establishing exposure to inflation-leveraged tangible assets. This could be through commodity-linked securities, precious metals producers, energy equity positions, or even direct ownership of productive agricultural land. The key is to own things that possess intrinsic value and pricing power in an inflationary environment. And finally, remain informed and remain adaptable. The sovereign debt markets are dynamic and the situation is developing continuously. You need to be monitoring curve dynamics, central bank communications, and macroeconomic data on a weekly basis. This is not a passive allocation environment. This is a moment that demands active awareness and strategic positioning. Before we conclude, I want to ask you a direct question, and I want you to respond in the comments section below. Do you believe the yield curve stress we're observing currently is a temporary technical dislocation, or is this the beginning of a larger sovereign debt crisis? I'm genuinely interested to understand your perspective, because the discussion occurring in the institutional community right now is intense. Some strategists believe central banks will intervene and stabilize the curve dynamics like they did in 2012 and 2019. Others, myself included, believe we've reached a threshold where the debt accumulation is so massive that no amount of intervention can prevent a major restructuring. I want to know your position. Share your answer in the comments and let's create a genuine dialogue. And here's the final request. If you extracted value from this analysis, if you recognize that what we just examined is information you won't receive from mainstream financial media, traditional market commentary, or conventional investment advisors, then I need you to do two things. First, click that subscribe button and activate notifications so you don't miss the subsequent videos as this situation continues developing. I'm going to be tracking yield curve dynamics, precious metals markets, and macroeconomic indicators in real time, and you need to be connected. Second, share this video with anyone you know who cares about protecting their financial future. This is not the time for restricting information. This is the time for community, for education, and for strategic preparation. The sovereign debt markets are signaling distress. Institutions are constrained. The systemic dislocation is materializing. The only question remaining is whether you're going to recognize it in time to position yourself on the advantageous side of the allocation. I'll see you in the next one. Stay informed, stay prepared.